icons are at the bottom there on your screen, and switch off your cameras. Otherwise, the bandwidth is not enough and the presentation starts to freeze. Also, if you have any questions, there's a chat box there. Icon is there at the bottom. Please type any questions that you may have as I go through the presentation. Rishini and Yamuna will both capture the questions, and we can take it up at a Q&A session, which will be at the end of this presentation. Okay, so I'm moving on to the presentation now. Right, so as I mentioned earlier, the agenda is that we will start at the beginning, understand how and when an employee or an individual, more specifically an employee, begins to be liable for income tax. Then what are the changes that have taken place based on the pay-as-you-earn taxes scheme vis-a-vis the new schemes that have been introduced? What are the changes to the tax slabs, tax rates, any new reliefs that have been introduced, your statutory obligations, how and when tax should be paid, how to comply with those statutory obligations from opening a file to making the payment to filing your return. All that we hope to capture throughout these presentations. Right. So starting at the beginning, the basis of liability. In case of an individual who is resident in Sri Lanka, an individual is liable to tax on global income from all sources of income, that is, be it employment income, business income, investment income, or other income. A resident individual is liable to tax from all sources, right? And a resident individual is a person who is present in Sri Lanka for a period of 183 or more days in a 12-month period. Right? A non-resident is only liable to income tax on sources derived in Sri Lanka, aggregate sources derived in Sri Lanka. So a resident is liable on global sources. A non-resident is liable only on income sourced in Sri Lanka. Chargeability. So commencing first from January to March, an individual is liable to income tax. An individual is liable to pay income tax on income that is more than 250,000 per month or 750,000 per quarter during the period January to March 2020. From April onwards, that's where we move on to a new year of assessment. That is the year of assessment 2021. You will be liable to income tax only if your monthly income from all sources exceed 250,000 per month or 3 million per annum. Okay, so for the period, to reiterate, for the period January to March 2020, you will be liable to pay income tax on your aggregate sources of income if your monthly income exceeds 250,000 per month or 750,000 per quarter. For the period April onwards, you will be liable to pay income tax if your monthly income exceeds 250,000 or your annual income exceeds 3 million. Okay. Right. So this is the basic flow of how you arrive at your taxable income or your tax liability. This is the summary. Don't worry, we'll be going through each of these stages as I go through the presentation. So we start off with all your sources of income, each source of income, aggregate source of income. From that, you take out any exempt income you might have or any income that was subject to a final withholding. You can also deduct any permitted expenditure. And now this is not available for employment income. Against your employment income, you cannot deduct any expenditure other than reliefs, which I will come to later on. If you have, say, business income or investment income, from such sources of income, you can deduct a permitted deduction. So you can take away your permitted deduction. Then you arrive at your assessable income, the income that gets assessed. Out from that, you can also further take out qualifying payments reliefs and your other reliefs, such as your tax-free allowance. We'll come to that. Don't worry what those things are. We will come to that. This is just the flow of how you arrive at your taxable income. So once you take off your qualifying payment and other reliefs from your assessable income, you arrive at your taxable income. Okay, so now I mentioned earlier that your income should be your aggregate sources of income. So that is your business income, investment income, employment income, and other income. Now I will take each sources of income and take you through the changes that have happened with respect to these sources of income. Most of the changes revolve around employment income. That's where a lot of the changes have taken place. So we'll spend some time on that. And before I go into this in more detail, I'd just like to mention that all these changes have been introduced by web notices issued by the Inland Revenue Department, which have been issued, withdrawn, reissued, reiterated. None of this has been implemented by way of law, where the law has to be changed. It has not been changed, not been amended. So some of it may not be clear, some of it could be arguable, but in broad, what I am going to say here and going to take you through is the intention of the policymaker. What is it that they wanted us to do, and what is it that we have to do to comply with those, with the intentions as expressed in those web notices. The legality of that is another academic question, which we won't take up here, and we will go by the web notices. So starting off with employment income. So in case of employment income, you have your cash benefits. Then you have your non-cash benefits. Those are benefits you get in kind, like such as motor vehicles, housing benefits, utility bills paid by your employer, any employment share option schemes that you might have. And then you get your terminal benefits. Your cash and your non-cash benefits together are your regular profits from employment. Terminal benefits are the benefits package you get at the time of your termination, which includes EPF, your EPF contribution, ETF contribution, pension contributions, gratuity, and so on. Now, in case of non-cash benefits, the rule given is that, the rule given and what is there in the law is that for non-cash, to value the non-cash benefits, you should first take market value of that non-cash benefit. But if the market value is not available, then, or if it is not available or it's not readily ascertainable, you can use the benefit valuation table that has been given by the Commissioner General of Inland Revenue in his guidelines, right? So where you can take the market value, you take the market value. If you can't get the market value, then you use that table. For those of you who want to make it simpler, you could ask your employer, please give me my gross remuneration from regular employment, which is my cash plus non-cash benefits. Your employer should know how to value your non-cash benefits. It's not something new. It has been there in the past few years. Right. So from employment income, there are some exclusions and exemptions, which you are as an employee eligible to. You have to be mindful of that. So you have your regular profits from employment. From that, these things are excluded or not liable to tax. If I just take you through the list, one is your discharge or reimbursement of the personal, dental, or medical or health insurance expenses, if available to all employees on equal terms. So that's where your employer gives you a medical health insurance scheme, which is equally available to all employees on equal terms. Then that benefit is not taxed in your hands. Any official expenses that are reimbursed to you, that's where you pay out of your pocket and your employer reimburses official expenses. You need not tax that any further. You need not have that as a taxable benefit in your employment income. Then any benefits that are accruing to employees on a non-discriminatory basis, which, you know, by their size and their frequency is not administratively possible to account for individually, you can ignore that also. For example, like tea, or tea the employer, tea or coffee employer gives you. it's too small, not in terms of value, but value per individual. It's not possible to identify that, so that's available to everyone. You can exclude that. Then the employer's contribution to approved pension, provident, gratuity, or savings fund are also not part of your profits from employment. And there are also some exemptions that are given. The amounts you receive on termination from a provident fund approved by the Commissioner General is also not considered taxable as part of employment income. Then the investment income from any pension fund or employee trust fund which you get is also not taxable in your hands. Any compensation or gratuity paid in lieu of personal injuries or death that you may have suffered personal injuries during your tenure work, those payments are also not liable to tax in your hands as profits from employment. Right, moving on. Now we move on to the pay-as-you-earn taxes scheme and Advanced Personal Income Tax Scheme, or APIT, that has been introduced with effect from 1st April 2020, right? So under those two schemes, we have divided it into two parts. One is the implication on your terminal benefits, and one is the implication on your regular profits from employment. I'll start with terminal benefits because that's the easier one to get out of the way and understand. So with respect to terminal benefits, now these are benefits that you get on termination of your employment. With effect from 1st January 2020, the concessionary rates and slabs have been revised to the advantage of the employee. So according to the revised rates and table, the first 10 million you get from your approved package of approved commuted pension, retiring gratuity, ETF or compensation. The first 10 million is tax-free. The next 10 million is at 6% and the balance is at 12%. So on termination of your employment, if you get a package which is approved, considered approved as in it's from an approved provident fund, approved pension fund, and approved compensation for loss of office scheme, or from your ETF fund, then the first 10 million is not taxed. The second 10 million is taxed at 6% and the balance is at 12%, right? So these have been revised, and it has been revised in favor of the employee with effect from January 2020. Now, the previous slide, this slide is the employee's chargeability. That is the rate at which employee should pay taxes on your package from termination. Next slide is the employer's responsibility or the employer's obligation to deduct taxes. Okay. So with effect January 2020, the withholding on terminal benefits released by the employer is mandatory, and it will continue even after January, even after April under the APIT scheme. So this part has not changed vis-a-vis the previous PAYE scheme. Under the PAYE scheme also, terminal benefits were liable to tax at source. That taxability, that liability is continuing even under the new schemes. So the employer will deduct taxes on your terminal benefit in the following manner. For the period effective from January 2020 onwards, if your aggregate income from the total termination package is more than 5 million, it will be 12% on the excess of 5 million. If it is not approved compensation package, it will be, the employer will withhold 18%. Okay. So if it is an approved scheme, your employer will withhold 12% on excess of 5 million when they release your terminal benefit package. If it is not approved, they will withhold 18%. Now, in the previous slide, as I mentioned, this is your actual chargeability. So you can see the rates here are much lesser because you get the first 10 million is exempt in your hands. And it's only the next 10 million that is taxed at 6% and the balance at 12%. So since the employer is going to deduct at these rates, there might be a situation where the employer has deducted taxes in excess of your actual chargeability. So in that event, what happens is the employee has to go to the the Department of Inland Revenue within 90 days and get a direction by showing, look, this is my actual liability based on the table given here. Based on the table given here, this is my actual liability. But the employer has deducted this X amount in excess. So much has to be refunded to me. I need that refunded, and you go and inform that to the Commissioner General, and he will give you a direction. He will give you a direction which is issued on the employer to release the excess taxes. So all that has to be done in 90 days. This is actually not something new. This was there under the previous scheme as well. Okay, so now we move on to regular profits from employment. So this slide actually captures a summary of what has taken place from January to April via the web notices issued by the Inland Revenue Department, right? So if we start at the beginning, before January 2020, on your employment income, from regular profit from employment income, PAYE was deducted by the employer at source, and it was a final tax. That was before January 2020. Then by notices 5th February and 12th February, the department issued a notice which says that PAYE was abolished other than on terminal benefits. So PAYE was abolished, but taxes will continue to be deducted on terminal benefits, irrespective of the fact that PAYE was abolished. So employees were required to pay tax on their own on a self-assessment basis. So PAYE was abolished. Employer was not going to deduct taxes. Employee was required to pay taxes on their own on a self-assessment basis if their income was in excess of 250,000 per month. Then on 8th April, another notice was issued, a web notice by the Inland Revenue Department, which introduced APIT, or the Advanced Personal Income Tax Scheme, with effect from April 2020. So they abolished a PAYE, but with effect from April 2020, they said, look, okay, a PAYE is abolished. But if you feel that it is easier for you to ask your employer to deduct the taxes at source, fine, you can do that. That scheme is now called APIT. It's on a voluntary basis. Employee has to make a request from the employer to deduct the taxes. But it is not a final tax. Unlike in the previous PAYE scheme, it is not a final tax. And even if taxes are deducted by the employer, you are still required to file a return. Okay, if your monthly income is more than 250,000. Then the confusion comes by the notice dated 15th April 2020, where the Commissioner General said, look, I abolished PAYE effective from January, but 15th April, he says, but as a help to you, I understand, and you are having some difficulties paying your taxes on your own. And as a help to you, and for your convenience, I am asking the employer to deduct the taxes from January to March, or deduct taxes from January to March, if you as an employee request the employer to do so. Now, by the time this notice was issued, it was 15th April, mid-April, by which time employer had already released your January, February, March employment salary to the employee. So the Commissioner General said, well, what you can do is January, February, March, if the employer has already released your salary, you can ask the employer to deduct the total tax attributable January, February, March from your April income. Or if that is also not possible, then you can agree with your employer on a method of deduction, but you can ask him to deduct, right? So that was what happened on 15 April. So now, just to summarize, from April 2020 onwards, APIT is there. That is where you can voluntarily ask your employer to deduct taxes from your employment income. It is not a final tax. For non-residents, this APIT scheme is mandatory. It's not voluntary. They can't decide to pay taxes on their own. They have to ask the employer to deduct taxes. For residents, you can opt to come under the APIT scheme. PAYE on terminal benefits to continue. It's not PAYE, but it's tax on your terminal benefits are to continue, where the employer will deduct taxes on your terminal benefits. Okay, so now let's just look at the taxation of a non-resident first, and then we will move on to the taxation of a resident. with respect to employment income. Okay. Taxation of employment income in case of a non-resident. This is the summary of what is taking place right now. So up to 31st December 2019, the non-resident was also under the PAYE scheme where the employer deducted taxes and it was a final tax. From January to March, the department issued a web notice stating that in case of a non-resident, 14% tax has to be withheld by the employer, and that is a final tax. April onwards, they have issued a web notice which stating that the non-resident can also come under the APIT scheme, but it is mandatory. That's where the employer has to deduct taxes at source on employment income in case of a non-resident, right? So there is a little bit of a discrepancy between this period and this period because in case of an individual, the progressive tax rates go from 6 to 18%, 6% effective from January, 6% to 18%. But for this period, January to March, in case of a non-resident, we are deducting a 14% flat rate, which may not be the case for certain non-resident individuals who may be in a lower bracket and therefore chargeable at 6%. But whether they liked it or not, 14% was deducted and that was final. So there is a bit of discrimination there. And that this could be an issue under the double taxation agreement treaties we have with certain countries. This is what has been issued to us. Like I said, there are certain issues when it comes to the legality of certain things, which we won't go into discussion here because it will get very complicated. But in summary, this is what a non-resident's liability looked like from January onwards. Taxation of a resident employee. That is the majority of those of you who are watching this. So, in case of a resident employee, their profits from employment can be twofold. One is primary employment and one is secondary employment. That is where if an employee is employed by more than one employer, the employee is required to declare what is his primary employment income and what is his secondary employment income. Okay. Now, whether you can opt not to come under the APIT scheme, that is, you can ask your employer not to deduct taxes from your employment income, but nevertheless, you still have to give the declaration of what is your primary employment income and what is your secondary employment income. Now, this is basically what the primary employment income declaration, the information that you need to give. So you're supposed to declare this if your profits from employment is more than 250,000 per month or 3 million per annum. So this entire presentation is for those of you who are more than 250,000 per month. Okay. It must be signed and dated by the employee. You can give this declaration for more than 1 year of assessment. You can't have more than one primary employment at one time. Obviously, the term primary means primary, so it has to be one. Everything else will be secondary. You are only able to withdraw this at the end of the year of assessment unless you cease primary employment. Now, there's a little bit of a confusion here. The guidelines issued, the APIT guidelines say that you can't withdraw this primary employment declaration form midway during the year. It's applicable for a year of assessment unless you cease employment. The form, of course, goes on to give sort of a statement which says that the PED, the primary employment declaration form, is valid until such time otherwise declared by me in a declaration. So the PED form has a sentence which suggests that you can withdraw it midway during the year, but the guidelines clearly, the APIT guidelines clearly say that you are not able to withdraw it and it's valid for a year of assessment unless you cease employment. And we clarify this with the department. Department also states that you can't, once you give it, you can't take it back. It's applicable for a year of assessment. Everything else, it will be your secondary employment. Every other income you get from other employers will be secondary employment. There is a form for that also. And in that form, you have to declare your income that you get from a primary employment. So I'll explain this to you. So you have your regular profits from employment. It can be twofold. You can be working for more than 2 employers at a time. If you are being employed by multiple employers, then you have to make a declaration of which employer is your primary employment and which employer is your secondary employment. Once you do that, your secondary employment your primary employment will be taxed as per the regular monthly regular tax tables. If you have asked your employer to deduct the taxes, your secondary employment will be taxed based on the bracket in which you fall for your primary employment. Say, for instance, you have declared in your primary employment form that your employment income bracket falls between 250,000 and 500,000. Right? Then you are taxed at this rate, at 6%. So whatever your secondary employment, whatever you get is taxed at 6 rate. Or you have declared in your primary employment declaration form that your primary employment income falls within this bracket, 500,000 to 750,000. Then your secondary employment, whatever it might be, is taxed at 12%. Right? That is for a resident. In case you're a non-resident, your secondary employment is taxed at a flat rate of 18%. Yeah. Right. Now, again, just to remind you, this is if you opt to come under the APIT scheme, and if you do come under the APIT scheme, employer will deduct taxes, but it is still not a final tax. You need to file your income tax return annually. Right. So these are the tables given under the new APIT guideline. I understand that the tables have been changed last night. So there are a few changes. The department has highlighted it in red. I've actually not gone through that, probably to the formulas, but the basic principles or the basic concepts remain the same. So these are the tables that the employer will be using to deduct taxes from employment income paid to employees in the event the employee has requested the employer to deduct taxes. The tax table 1 is the table to be applied on regular profits from employment of any resident employee who has given consent for taxes to be deducted by the employer. Or it also applies to any non-resident employee who is a citizen, because in case of non-resident employee, the employer has to deduct the taxes. There is no option given there. Tax table 2 is the table to be applied for your lump sum payment. That's where the employer pays you bonuses. This is the table that will be applied. Then you have tax table 3, which will be applied for your terminal benefits. In this case also, this table will be applied with or without your consent, because the guidelines have clearly stated that in case of terminal benefits, employer has to deduct taxes at source. Tax table 4 is for a non-resident who is also a non-citizen. Tax will be deducted again by the employer, whether the employee likes it or not, in case of a non-resident. Then this table, tax table 5, is where your monthly regular profits from employment is less than 250,000, but your annual income, your cumulative profits for the year is more than 3 million. There can be a situation where you fall below 250,000 per month in certain months, but then you get a promotion or your package is revised, and then in aggregate you come within the 3 million. Your cumulative profits will come up to 3 million. In such an event, you have to use tax table number 5. Tax table number 6 is for a case or scenario where the employer bears your tax, that is where tax on tax, where employer bears your tax which should be paid by the employee. Tax table 7 is secondary employment. That's the table that will apply on your secondary employment. So again, this is the APIT table scheme that the employer would apply in the event, in case of a resident employee, the employee has asked the employer to deduct. Okay, so now we move on to the other sources of income. What I explained all this while was your employment income. Now we are moving to other sources of income, investment income, mainly investment income. And here there is what we call an advanced income tax scheme. So let's take a look at what that is and how it affects you all. So what is advanced income tax? As per notice dated 8th April 2020, the department issued a notice or a scheme referred to as the advance income tax scheme, whereby a recipient who gets a fixed regular payment can request the payer or the withholding tax agent to deduct taxes at source with effect from 1st April 2020. Now, just to take a step back, effective January 2020, PAYE was abolished, and so was withholding taxes on other sources, on investment, other sources of income was also abolished. For example, on interest, on rent, on dividends, withholding tax which was deducted prior to January 2020 was abolished. So that withholding tax scheme was abolished, PAYE was abolished. So for January to March, there was no PAYE, there was no withholding tax. So now advance income tax was then introduced effective April 2020, that's for the year of assessment 2021, where the recipient of a fixed regular payment can still ask the payer or the withholding agent to deduct taxes at source when paying that fixed regular payment to the recipient. The fixed regular payment in that notice has been referred to as payments such as rent, interest, dividend, service fees, and so on. Now, interest and dividends, for instance, may not be fixed regular payments, but nevertheless, the nomenclature fixed regular payment has been given to those payments. So you can ask the withholding tax agent to deduct taxes at source when they release these payments to you. But again, it is not a final tax. It is not a final tax. You have to aggregate the sources of income and pay tax at progressive rates. So we'll come to that as we go along again. So now going forward, I just want to give you a snapshot of how your interest income from the interest will be classified under investment income. What is the change that has taken place for your interest income you receive, okay, as an individual? So prior to 1st January 2020, withholding tax was mandatory on interest income, as you all know. A 5% tax was deducted at source by the banks and the financial institutions, and that was a final tax, right? It was a final tax. You need not have declared that, and if you had only interest income, you need not have declared that and filed a return. In case of senior citizen, the 5% was on anything exceeding 1.5 million. 1.5 million was exempt. Anything exceeding that was deducted at 5% at source, and it was a final tax. Now, effective January, withholding tax was abolished. So this is what happened to your interest income. In case of a senior citizen, for the period January to March, 31st March 2020, there is no withholding tax deducted on your interest income. You have to declare your interest income. A senior citizen has to declare the interest income, which is in excess of 1.5 million per annum, and pay tax at progressive rates. So the progressive rates go from 6 to 18%. Previously, anything in excess of 1.5 million, you paid a tax of 5% and it was final. But now, anything in excess of 1.5 million, you have to declare on your own and pay taxes depending on your tax bracket, and that can go up from 6 to 18%. That's up to March. Then from April 2020, you can ask the withholding agent, in this case it will be the banks or the financial institutions, to deduct the taxes if you want at source. But it is not a final tax. You still have to aggregate your sources of income, pay tax on that interest income on progressive rate 6 to 18%. And you can take a credit for the tax that was deducted at source by the financial institutions. Now, the guidelines of this AIT scheme is still to be issued. So the rates of deduction has not been specified, but it is an advance income tax, meaning you can request it. It is not mandatory. Under the previous withholding tax, it was mandatory. This is on request. You can ask the agent to deduct it if necessary. So for other individuals, as a non-citizens, previously 5% was deducted as a final tax. Up until 31st March 2020, there was no withholding tax because the withholding tax scheme was abolished. So you have to then declare the interest income between the period January to March and pay at progressive rates if you are chargeable. That is, if your income is in total more than 250 per month. From April onwards, you can ask the banks to deduct taxes at source if you so wish, but still you have to declare this and pay income at progressive rates. You will get credit for the taxes deducted at source, but this deduction is on your request. For interest income on treasury bills and treasury bonds, Even before January 2020, there was no withholding tax. Individuals are supposed to pay 5% on a self-assessment basis, and it was a final tax. Going forward, there is no withholding tax even from January, and even from April, you cannot come under the AIT scheme for treasury bills and treasury bonds because of the nature of the mechanism by which treasury bonds and treasury bills are administered. You can't. There is no way of to withhold. So there will be no withholding tax. You are to declare the total income, and if it is more, your total aggregate income is more than 250,000 per month, you have to pay tax at progressive rates. It can go up from 6 to 18%. Other securities like your corporate debts and so on, again, previously there was a 5% withholding tax. It was final. Going forward, up until March, no withholding tax. You have to pay at progressive rates. From April onwards, in case of other securities, you can ask the withholding agent to deduct taxes if you so wish, and you can take a credit for it, but still you have to pay taxes at progressive rate. So in case of non-residents, the previous slide was for residents. In case of interest for non-residents, individuals who are citizens of Sri Lanka but still non-resident, previously before January, it was a 5% tax and final, simple. Going forward, it will be a 5% tax and it will be final for individuals who are non-residents and who are citizens. Please note that in case of individuals who are non-resident but citizens of Sri Lanka, it's the withholding of 5% will be applicable if the aggregate interest income exceeds 250,000 per month or 3 million per year of assessment for the period 1st January and for the year of assessment 2021. For the period January to March, if it is exceeds 750,000, right? Other individuals, that is those who are non-residents and non-citizens, previously it was a 5% and final tax. Going forward also, it will be a 5% and a final tax. Treasury bills and bonds, there was no withholding at source. Post January 2020, and this was by notice, it has not still been, I think, legislated. Treasury bills and bond income is exempt to non-residents. The other sources of relevance, we haven't taken every other source. We have just taken some sources which we believe are relevant to employees. Employees mostly would have profits from employment and maybe other sources such as interest in dividends and rent income and some service fee, if any. So we have only captured the implications for these things. Other sources like business income and all is an entirely different ball game and it gets too complicated. So we did not touch on that. So if you have rent income and you're a resident, previously there was a 10% withholding tax that the tenant would withhold and is supposed to pay to the department. Going forward, until March 2020, there is no withholding tax. So if any rent income the landlord receives, they are supposed to declare it and pay income tax on progressive rates, provided your aggregate income is more than 250,000 per month. From April 2020 onwards, you can ask the tenant to deduct taxes at source if necessary, and you can take credit for it. But that's if you want only. You can come under this advanced income tax scheme. For dividends, previously 14% tax was deducted. It was a final tax. Simple. Now, from January onwards, there is no withholding tax on dividends. The recipient is supposed to declare the dividends as part of the aggregate sources of income, and where it exceeds 250,000 per month, the progressive rates will apply. So it will go up to 18. It can go up to 18% depending on your individual tax bracket. Okay, so there's an increase in tax there, 14 to 18%. In case of interest also, it can go up to 18% from the previous 5%, depending on your tax bracket. Right, so royalty, again, 14%. It was not a final tax. You could get credit. Now, going forward, from January onwards, there is no withholding tax. So you have to declare it again and pay tax at progressive rates. If you opt for it, you can come under the AIT scheme for royalties also, where you ask the payer to deduct taxes and you take credit for it when you're calculating your taxes. Service fees, that is any consultancy fees you get. Previously, 5% was deducted by the payer on anything in excess of 50,000, but again, it was not a tax. You would get credit for it. Going forward, from January 2020, there is no withholding tax on these service fees. and it won't be a regular fixed monthly income, obviously, because it will change your service income as a consultant monthly. So there won't be taxes deducted at source. You can't come under the AIT scheme. You are supposed to declare income and pay taxes on your own on a self-assessment basis. In case of a non-resident, this is the chargeability going forward. It is pretty much the same as what it used to be in the past, except for dividends, where now dividends declared to a non-resident is exempt, whereas previously it was at 14%, now it is exempt. So moving on. So these are some exemptions of relevance. If you remember at the beginning, I said you aggregate your sources of income and you take out any income that is exempt from income tax. So these are the sources that are exempt from income tax, and these are only some of the sources that I have put down, some sources of relevance. So if I'm just to take you through it, any income you get in foreign currency, where you have rendered a service to a person outside Sri Lanka to be utilized outside Sri Lanka, and you get paid in foreign currency, and that foreign currency is remitted back to Sri Lanka, that income is now exempt. Then foreign dividends, that is where you have then substantial holding in a company outside Sri Lanka, and you get a dividend coming into Sri Lanka. It has to be remitted back to Sri Lanka. That dividend is also exempt in your hands. Substantial holding is defined in the Inland Revenue Act. Then if you have any business income from agro farming without any further processing, that income is also exempt. Why I put this is because some of you may have estate income coming from your estate, coconut estates and so on. So I just mentioned that. Then, of course, something that is very relevant to this sector is the income you get from your IT and IT enabling services is also exempt in your hands as an individual. What is IT and IT enabling services is yet to be defined, but so far you can take a broad caption of that. Then any interest you get from any foreign currency accounts that are maintained in our local banks and financial institutions, which are approved accounts by the CBSL, are also exempt. So your NRFC, RFC, PFC, BFC accounts, all those accounts, the interest you get from those accounts are exempt. Then any interest or discounts on any sovereign bonds denominated in foreign currency, including Sri Lanka development bonds, is also exempt. And this exemption is backdated to April 2018. Okay. If you have any income from these sources, please be aware they are exempt. So right, so now we come to your assessable income. So as I said, you aggregate all your sources of income. You take out exemptions, any income that is exempt. You take out any permitted deductions in case of you have business income or investment income. Then you arrive at your assessable income, and then from your assessable income, so this is your aggregate. So your aggregate income is your business income, your investment income, which would include interest, dividend, rent, capital gains, etc. Your employment income, including terminal benefits, other sources. So this is your total aggregate income, excluding exempt income. Then you arrive at your assessable income, and from that you get to deduct further reliefs, right? So let's take a look at what are these reliefs. So there are some reliefs. So the reliefs are twofold. You have your tax-free allowance and you have your qualifying payment reliefs. Qualifying payment reliefs are also twofold. There are some reliefs that are coming from the existing law under the existing Inland Revenue Act. There are some reliefs that have been introduced by these notices that were issued in January, which are yet to be legislated. So the existing reliefs are given here, that is donations to approved charitable institutions. There's a limit on that deduction, and any donations made to government institutions. These are the new reliefs that are actually introduced. These are the new reliefs that have been introduced by the paper notices that were issued recently. And there's a big benefit there. So they have introduced a qualifying an additional deduction in addition to your tax-free allowance. So your tax-free allowance going forward from January 2020 has been increased to 3 million per year of assessment. Okay. Your tax-free allowance is 3 million. In addition to that, they are giving you another qualifying payment relief or a deduction of up to 1.2 million from the year of assessment 2021 for the period 1920, since this qualifying payment relief was introduced only with effect January 2020. it has been prorated, and you will get a relief of up to 300,000 for the period January to March. And these are the things, 5 things that you can deduct, okay, under qualifying payment relief. So you can deduct any health expenditure, including contributions to medical insurance. You can deduct educational expenditure incurred locally for you, for yourself, or on behalf of your children. You can also deduct any interest you have paid on a housing loan. You can also deduct contributions made to an approved pension scheme. You can also deduct expenditures incurred for the purchaser of equity or security in the capital markets, right? Now, the total deduction from all these expenditure is limited to a 1.2 million for the year of assessment 2020 onwards. For the period January to March, it was introduced in January. So for the period January to March, it has been prorated, and you can claim a total deduction of 300,000. Now, with respect to these deductions, the parameters or what is health expenditure, what is education expenditure has not been defined or given, right? For example, has health expenditure. Is it or to a medical insurance scheme? Can I deduct if I make a payment to a foreign medical insurance scheme? In case of educational expenditure, in case of my child's school fees, can I deduct payments where I have made it to an international school, or will these school fees be limited to schools registered with the Education Ministry following the local curriculum? It's not being deducted. Then for your ACCA, CIMA, and these foreign professional qualifications, you may be able to deduct the tuition fees you pay to follow the courses here locally, but your exam fees, your subscription fees may not be deductible because those are paid to a foreign institution and it is a foreign expense. Then interest on housing loan, is it do you have to have a loan classified as a housing loan from an approved commercial bank institution, or can I take a personal loan, use it for my housing purposes, and then deduct the interest I pay on that personal loan? Not clarified. Contributions, it mentions to a pension fund. So presumably, since the word pension scheme is given here, your payments you make, your statutory payments under the EPF and ETF cannot be deducted here under these qualifying payment reliefs, presumably. But no, it's silent, but since it's mentioned as pension scheme, it should be the case. Then expenditure for equity or securities. So this is where you invest in, say, shares in the stock market. You can actually deduct the full expenditure. That is the full expenditure you incurred in purchasing that equity. And even if you maybe incur expenses such as brokerage fees, commission expenses, such expenditure also should be able to be deducted. The word equity and security has not been defined, but at various forums, the department has indicated that they want to keep it as wide as possible to encourage people to take their money out of banks from fixed deposits and invest in the capital market, right? So this is the snapshot of your tax-free allowance and qualifying payment reliefs you get. Okay, so in case of the year of assessment 2021, very simple. All you have to remember is you get an annual tax-free allowance of 3 million, and in addition you get 1.2 million in qualifying payment relief, right? So this is a big benefit depending on your tax bracket, since the progressive rates go from 6 to 18%. On this 1.2 million alone, you can get a saving of between 72,000 to 206,000 per annum, right? So you have to be mindful of that. For the year of assessment 1920, things get a little bit complicated. The new notices were issued with effect from January 2020. So we have to therefore, in case of employment income, split it into two segments. So for the year of assessment 1920, in case of employment income, you have to split it between April and December. For the period April to December, you get 375,000 plus 525,000 in case of an employee, additional qualifying payment relief. In case of from the period January to March, you get a total tax-free allowance of 750 for the 3 months and a qualifying payment relief of up to 300,000 for the 3 months. Okay. So if I just let you know the tax slabs and the tax rates, calculation of employment income, you have to be mindful 9 months and the 3 months split. Year of assessment 2021 onwards, it will be the 12 months and get simpler. So these are the tax slabs. For the period April to December, year of assessment 90/20, that's a 9 months. 9 months period, these are the rates that would apply to you. Your approved terminal benefits get taxed at these rates and these slabs. If you have any gains on investment, it was taxed at 10%. That is your capital gains. If you had any income from the sin industry, that gets taxed at 40%. Remainder for anything in excess of these will get taxed from 4 to 24% according to these tax slabs for the period April to December, 9 months. For the 3 months up to 31st March, January 2020, January to March, right? Your gains on investment, the capital gains, continues to be taxed at 10%. Your approved terminal benefit package gets taxed at these rates, which is its additional benefit, an additional advantage for the employee because they have increased the tax slabs. Your income from any sin industry will continue to be taxed at 40%. Remainder will be taxed at progressive rates from 6 to 18%, and the tax slabs for the 3 months are these. So the first 750 at 6, the next 750 at 12, balance at 18. For the year of assessment 2021, very simple. Your tax, same thing, your capital gains at 10, your approved terminal benefits at this same concessionary package, sin industry at 40, the remainder at 3 million, 3 million tax slabs going up from 6 to 18%. Okay, so calculation of tax payable. All right. Now, I just want to take a few scenarios, and these scenarios will probably also give you an idea of whether or not you should ask your employer to deduct taxes at source. Okay. Now, the question a lot of people have, a lot of employees have in their mind is, should I come under the APIT scheme and should I voluntarily ask my employer to deduct taxes? Right. So now these scenarios I'm taking will give you an understanding of whether or not you need to do that. It depends on each individual's tax bracket and tax income and sources of income. I'll take you through this. You can figure out which scenario you fall into and you can make that determination. So let's say scenario 1, you have only employment income, okay? An individual has only employment income and you ask your employer, this is for the period January to March, okay? So January to March, you have only employment income and you have asked your employer to deduct taxes even for the period January to March, right? So what happens here is you have your employment income, okay, which is an X amount. You get to deduct your tax-free allowance plus qualifying payment relief of 1,050,000 for the 3 months, right, in total. So then you arrive at your taxable income. So your tax you have to pay at these progressive rates based on these brackets. Now, as I mentioned, it's the taxes are not a final tax. So you're supposed to calculate it and you arrive at your tax payable and you can take credit for the payee the employer has deducted at source. Now, when your employer has deducted taxes at source for the period January to March, the tax payable takes into account only the tax-free allowance of 750. The tax-free tables has not factored in the additional income of 300,000 on additional qualifying payment relief of 300,000 in arriving at the withholding rates under the payee tables or under the payee tables. Okay, so if you have asked your employer to deduct taxes during the period January to March at source, and you thereafter realize you can claim a further deduction for qualifying payment relief because you had some medical expenditure, because you had some educational expenditure of your child. So you feel that you can claim a further expenditure of up to 300,000, you may end up with a refund. Okay. But if you have only employment income and you don't have any other qualifying payment relief that you are going to claim, right, then you will not have a tax payable. You will not have a tax payable, right? So you will have no self-assessment payment to be made by the 15th of May. The 15th of May is the final quarter payment for the year of assessment 2020. You will not have any self-assessment payments to be made. You only have to open a file and file a return. That's it. But if you, that's it. if you have got a if you have asked your employer to deduct taxes, you will still have no. So two scenarios are possible under this scenario. If you've asked your employer to deduct taxes at source for the period January to March, and you have only employment income, you won't have a payment to be made on 15th of May. You still have to file a return, and when you file a return, if you do claim this qualifying payment relief, you may end up with a refund. You can claim that refund. Now, with respect to opening a file, if you have paid taxes on a PAYE basis for the January to March period, question is, when do I have to open a file? Can I wait till 30th November when the return filing deadline is due? Well, there is a little bit of a discussion point, or several schools of thought on this area. Okay, there are ways that the law can be interpreted and argued. The law as it is currently says that you have to open a file not later than 1 month after the base period if you are liable to open a file. So the base period is April to March, a year of assessment. So you're supposed to have opened your file by 30th April if you are required to open a file. But these notices came out by mid-January and then kept changing, and it came out in April. So far, if you are have an income of more than 250,000, you still have to file a return. So you can, as per the department, open the file before 31st May, and you're supposed to file a SET. That is a statement of estimated income, which each person is supposed to file on a quarterly basis, estimating their income for that quarter if you are chargeable to income tax. But really, this is ideally to be paid in the first quarter, that is 15th of August 2019. But all these changes took place much later from January. So the filing of this is actually defunct, but the department has said that it is better that you open the file by 31st May and file the SET. It's no longer estimated because you know your actual income from April to March by May. So the conclusion is, you open your file by 31st May, you can file your return by 30th November. You will have no taxes to be paid if your employment income is subject to PAYE for the period January to March. Second scenario, you have employment income which may or may not be subject to PAYE. Thus, you have other income like interest income and dividends. Okay. In such an event, since there has been no withholding tax deducted at source on these other income, and if your monthly income in aggregate is more than 250,000, chances are that you will have to make a payment on a self-assessment basis, right? So you have to open a file immediately, file a SET, but this SET, okay, I'm sure the department will not be very stringent on it for the year of assessment 1920 during this period, because so many changes have taken place and they are in a post-COVID situation. But you definitely have to open a file immediately, and you have to make a self-assessment payment by 15th of May, and you have to file a return by 30th November. So how you calculate your taxes are, you have your employment income, you have your other income, that is your rent, interest, and dividend. You get a tax-free allowance of 750 plus. You can claim up to 300,000 in qualifying payment relief where you have any, if you have actually had an expenditure. You arrive at your taxable income, and then you apply these tax rates and these tax slabs. You take credit for the PAYE, which if you have asked the employer to deduct, you can take credit for it. If you have not deducted, then you don't take credit. Then you pay your taxes if you have to, or due to this qualified payment relief claim, there may be a refund. It depends on what your monthly income is and what bracket you fall into. For April 2021, for April 2021, so it will be a scenario where you have, let's say, employment income, and you decide not to go under the APIT scheme. That is, you ask your employer not to deduct tax from your employment income, and you have other sources of income, then certainly, yes, you will have to pay taxes on a self-assessment basis. And the payment dates are 15th August 2020, 15th November 2020, 15th February 21, and 15th May 2021. So you have to open a file for the year of assessment 2021 before 15th August, and you have to file a statement of estimated income of your income for the year before 15th August and make a payment on a self-assessment basis. And this is the manner in which you calculate. For the year of assessment 2021, you can take up to 1.2 million and 3 million as tax-free allowance. Okay, let's say you are asking your employer to deduct taxes on your employment income, but still you have other sources of income, okay, which may or may not be subject to advance income tax. You still have to, you will have to calculate taxes and see whether you are arriving at a liability and whether you have to make self-assessment payments for the quarter. You will definitely have to open a file before 15th of August 2020 and file a statement of estimated tax payable, and you have to file your return. So you calculate your taxes in this manner. You can do this before the 15th of, you can do this before, you can do this calculation actually immediately and see whether you are going to arrive at a tax payment or a tax refund if you ask your employer to deduct taxes at source, right? You can check that out and see if you are arriving at a refund, then maybe the better method is to ask your employer not to deduct taxes from your employment income, or ask the withholding agent not to deduct advance income tax from your investment income, right? So it depends on each individual, depends on their sources of income, depends on which category they are in. So this is how you arrive at your tax payable, which I discussed so far. Just take you through the process of opening a tax file. You can do it online now. Currently, you can go online and open your tax file. So you go to the IRD home menu, you access e-services. There's a quick guideline there. You can look at that if you need it. You have to access e-services, go to taxpayer registration, select registration type as individual local, fill in details. You have to fill in your name, address, telephone number, things like that. I think you need to also upload as documents a scanned copy of your NIC. You submit it, then IRD will be sending you a PIN via your your email. Suggest you use your personal email for this purpose. Once you get the PIN, you can use the PIN to log in, and you have to change your password. The PIN, you have to change it to a password, secure password for yourself, and this because the PIN will expire in I think 40 days. Then you request for the tax type registration, individual local. That's how you. You can also make your self-assessment payments online if you have to make a payment on 15th of May. It's called an alternative tax payment system. You can make it through an online fund transfer. These are the banks you can use, do that online fund facility, right? The process is this. You go to the online payment function, select fund transfer option. You have to log into the online banking system of the bank. Select fund transfer of your personal bank. Then you select the fund transfer option, right? Then you have to check. You have to enter the beneficiary account number. The beneficiary account number. The beneficiary is the CGIR. The account number is this. Please make sure you type it accurately. Beneficiary name is the Commissioner General of Inland Revenue or CGIR. The beneficiary's bank details are the Bank of Ceylon, Tabro Bay branch. Payment reference code is the combination of your file, your TIN, the file number you opened previously, and tax type code, which for individuals is 05. Without any space, type it without any space in the reference page field and enter. You have then made your tax payment online, which you can do without having to go to a bank. Just to give you an idea of the penalties that you may incur if you do not fulfill your statutory obligations. So if you fail to register when you are supposed to register, there is an penalty of 50,000. For not filing the tax return, there is a penalty of 5%, plus a further 1% of the tax owing for each month, and 50,000 to 10,000 per part of the month, and the amount of the penalty in respect of the given tax return shall be limited to 400,000. If you fail to pay all or part of an installment of your self-assessment installment within 14 days of the due date, you have a 10% tax and an interest of up to 1.5% per month, which can be compounded monthly. Failure to pay all or part of your tax due for a tax period within 14 days from the due date. So this is if you fail to make it by the 15th of the quarterly payment, you get a 10% immediate penalty. If you fail to make it by the 15th and the department asks you to make a payment and you still haven't made it within another 14 days, the penalty will be 20% plus 1.5. Right. So these are the penalties. And these are actually, they are in the current law as well. We are assuming it will continue to apply going forward as well. Now, for you to understand whether or not you need to get your taxes deducted at source, and to find out actually what your tax liability for 15th of May is going to be, we have come up with a tax calculator, a simple tax calculator. It's available now, 4th of May, it's available now on our website. It's for the period 1920, and you can calculate your liability for the period January to March 2020 and see whether you need to make a payment on the 15th of May 2020. Okay. So in case all of what I have said is a little too much for you, no problem. Just go to the calculator, enter your income January to March, the sheet, enter the data that they have asked for there, and you will arrive at whether or not you need to make a payment by 15th of May 2020. So that concludes my presentation. We will now start the question section. Over to you, Rishini.
Yes, Shaman, can you hear me?
Yes, I can. I can, Rishini.
Okay. About the quality of my video, so I'll anyway start off with the question. Shall we first explain a little bit about this? There were so many questions. Who to open a tax file under the new guidelines?
Okay, so everyone is required to open a tax file. Okay, everyone who has an aggregate income of 250,000